Folks, you better get ready because Warren Buffett is finally back and deploying his capital in a major way. And you're not going to want to miss this one. Warren Buffett has been quietly stacking mountains of cash on the sidelines for years. But here's the twist. The Oracle of Omaha has shifted gears and is now going full throttle, deploying this cash into very specific stocks. In today's video, we're going to break down what exactly Mr. Buffett has been doing, which stocks he has been loading up on, and the one stock that stands out the most. If you are serious about investing or you're just a fan of Buffett, well, buckle up because today we're going to be breaking down everything that you need to know. And as always, if you're the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Always do your own due diligence on all ideas presented. And quick plug, are you wondering what broker to trade these stocks on? Well, Moomoo, our partner linked down below, is an excellent choice, and they have a very extreme bonus for new members if you sign up using our link down below. We've sent them thousands and thousands of people. We've been recommending them for years, and you're going to like them. Okay, so Buffett. Now, what exactly is Buffett's strategy? Well, you got to remember that Warren Buffett is a very bread and butter kind of guy. His approach to the market is simple but genius. He looks for companies with three things. Number one, a competitive edge that makes them hard to beat. Two, consistent, steady profits year over year. And number three, a clear and understandable business model that's undervalued compared to what it's truly worth. And he doesn't overcomplicate things. If a business is profitable, straightforward, and underpriced, Buffett buys it. Period. So whenever he makes a buy, people pay close attention, and many people buy in after him. So that's why it's so important to pay attention to today's video. Okay, so with that in mind, what are his most recent buys? Well, number one, Occidental Petroleum. Occidental Petroleum has become one of the largest single holdings in Berkshire Hathaway's portfolio, and there's good reason for that. Occidental is a low-cost lender in oil and gas production, particularly in the Permian Basin, an area known for its rich reserves and efficient drilling. What makes Buffett so bullish on Occidental? It's all about its fundamentals. The company's cost structure is so lean that it remains profitable even when oil prices dip. This resilience is a huge draw as it means Occidental can weather downturns better than its peers. Secondly, Occidental has made incredible progress in cleaning up its balance sheet. Following its $55 billion acquisition of Anadarko Petroleum in 2019, the company faced criticism for its debt load, but thanks to disciplined capital allocation and favorable oil prices, it has rapidly reduced that debt while rewarding shareholders with dividends and buybacks. The big picture that Warren Buffett is painting here, well, while renewable energy is on the rise, traditional old-school oil isn't going anywhere. We're jumping the gun and thinking, oh, everybody's just going to renewables right away. No, that's not what's happening. Most of the world, most of the time, vast majority of the time, needs traditional oil. It's still a very critical resource for transportation, manufacturing, and even green energy infrastructure itself. Buffett understands this, and his increasing stake in Occidental, along with warrants to buy even more shares in the future, underscores his belief that energy remains a cornerstone of the global economy. This investment isn't just a bet on oil prices, it's a calculated play on Occidental's ability to create sustainable free cash flow, manage risks, and capitalize on geopolitical shifts. And it has a long track record of doing this. This is a very bread and butter play that is on brand for Mr. Buffett. Number two, Pool Corporation. This is a surprising but strategic addition to Buffett's portfolio as well. It's the world's largest distributor of swimming pool supplies, equipment, and related outdoor products. Pool Corporation benefits from consistent demand in both residential and commercial markets. With over 400 locations worldwide, the company operates in a highly fragmented market, giving it a dominant position and significant pricing power. Now, I think that Buffett likely sees Pool Corporation as a play on long-term lifestyle trends. You see, really since the pandemic, there's been a massive surge in people that are spending money on things at the home, and especially pools. The stats show that homeowners have increasingly invested in outdoor living spaces, including pools, which have driven demand for Pool Corporation's products. The company also benefits from something that we absolutely love: reoccurring revenue. Pool owners, as you know, they require ongoing maintenance supplies and services, which as a pool owner myself are quite costly, which creates a steady cash flow. Pool Corporation's financials are a very, very big draw for the Buffett of Warren. The company boasts high margins, disciplined inventory management, and consistent growth in revenue and earnings. Its ability to expand both organically and through acquisitions aligns with Buffett's preference for scalable businesses with proven track records. Additionally, the company's geographic reach and operational efficiency provide it with a moat, a beautiful moat, in an industry with very few large players. We love companies that have big recurring revenue, small competition, and high cash flow. And that's exactly what Buffett is seeing in this stock. This company is very, very focused on customer relationships and very high margin products, which we love high margin. Buffett's bet on Pool Corporation highlights his ability to spot growth opportunities in niche industries with untapped potential. And this is a perfect example of a bread and butter play that while not extremely exciting, is something that prints money. Number 3, DPZ, Domino's Pizza. Now, Domino's is a time-tested pizza money printer. It isn't just a pizza company, it's also a tech-first logistics operation that happens to deliver one of America's favorite comfort foods. Now, personally, if I'm going to eat cheap shit pizza, I'm probably going to go to Costco because I like their cheese. But when it comes down to Domino's, I mean, hey, there's a lot of people that like Domino's, and it's very, very popular. Domino's has been very, very strategic at using technology to streamline its business and keep it relevant. Over 75% of orders come through its app or website, making it a trailblazer in the fast food industry's digital transformation. It's streamlined everything, really, from ordering, delivery, and even its supply chain. This focus on efficiency translates to lower costs and faster services, giving it a massive edge over its competition. Plus, its franchise-based model reduces capital requirements while generating steady royalty income, a structure that Buffett loves. Even in challenging economic conditions, Domino's has shined, and Domino's ability to pass on costs to customers without losing market share makes it incredibly resilient. The company's global reach, over 20,000 stores in 90 countries, adds another layer of stability. Buffett looks at Domino's and sees it as another example of scalability, stability, and adaptability, which again, if you look at Buffett's strategy, very bread and butter stuff, this fits perfectly. Number 4, Siri. Now, this one is a little bit unkosher for Buffett's strategy, but he's been buying this big and consistently. Siri is SiriusXM, a leader in satellite radio, represents Buffett's preference for businesses with consistent and recurring revenue streams. As a subscription-based service, SiriusXM enjoys a steady cash flow, making it less sensitive to economic fluctuations. With over 34 million subscribers in the US, the company dominates its niche, combining a strong moat with a unique product offering. Now, I've often thought of Siri as a dying business model because satellite radio is kind of a sunsetting industry. There's people that like it now, but will it still be popular in 10 to 20 years? Probably not. Buffett is looking at this in a completely different way. He thinks that the market of people that are already locked into that, he thinks that's really, really, really undervalued and underhyped. There's a lot more money to be made with those people over the next couple of decades. And he also thinks that Siri can pivot pretty aggressively. SiriusXM has also aggressively diversified into streaming audio content, competing with Spotify and Apple Music while retaining a loyal base of card-based listeners where it remains unmatched. Buffett likely values SiriusXM for its significant free cash flow generation. Number 5, HEI. HEICO Corporation stands out as a leader in aerospace and electronics, two industries with consistent growth potential. The company specializes in manufacturing parts for commercial and military aircraft, including components for avionics, engines, and airframes. HEICO focuses on niche, high-margin products that are often proprietary, which means competitive edge and a moat. Mr. Buffett likely appreciates HEICO's ability to generate consistent cash flow through long-term contracts with major aerospace players like Boeing and Airbus. The company's focus on aftermarket parts, which are less cyclical than new aircraft sales, ensures a steady revenue stream even during industry downturns. Additionally, HEICO's diversified product portfolio reduces its dependence on any single customer or program. The company's growth strategy involves both organic expansion and strategic acquisition. By acquiring smaller companies with complementary technologies, HEICO has consistently expanded its capabilities and market share. This approach aligns with Buffett's preference for companies that can reinvest earnings into high-return projects. As the aerospace industry continues to grow and sees massive demand, while HEICO is pretty well positioned to benefit. The company's ability to innovate and adapt to changing industry needs, such as shifting towards more fuel-efficient aircrafts, further strengthens its outlook. I think for Buffett, HEICO represents a perfect balance of stability and growth in a high barrier-to-entry industry, making it a valuable addition to his portfolio. But folks, here's the one that stands out the most. VRSN. You got to look at this one. So VeriSign is a fascinating addition to Buffett's portfolio and stands out as a quintessential Buffett stock due to its dominant market position, steady cash flow, and nearly impenetrable moat. VeriSign operates as the backbone of the internet, managing the infrastructure for .com and .net domain names. This role gives the company a monopoly-like status in its niche, as it is the sole operator of the .com and .net registries under a long-term contract with ICANN, the Internet Corporation, for assigned names and numbers. What makes VeriSign particularly appealing, though, is its business model. Every time a domain is registered, renewed, or extended under .com or .net, VeriSign earns a fee. With over 173 million .com and .net domain names registered globally, these small fees add up to a massive, predictable revenue stream. This subscription-like model, again, we love subscriptions, this subscription-like model ensures VeriSign's income remains steady regardless of broader economic conditions. Buffett, I would think, probably appreciates VeriSign's high operating margins, which consistently exceed 60%. Few companies can maintain such profitability while requiring minimal reinvestment. VeriSign's capital expenditure is extremely low because its business doesn't involve manufacturing, inventory, or physical distribution. This results in substantial free cash flow, much of which VeriSign uses for aggressive share buybacks, enhancing shareholder value. The company's pricing power is another critical factor. Under its ICANN contract, VeriSign can increase .com domain prices by up to 7% annually in 4 out of every 6 years. This ability to raise prices with minimal pushback ensures revenue growth even in a stagnant market. VeriSign's near monopoly in the space makes it extremely difficult for competitors to disrupt its business, creating a protective moat that aligns perfectly with Buffett's investment philosophy. Additionally, VeriSign benefits from the ever-growing importance of internet domains in the digital economy. As businesses and individuals increasingly rely on an online presence, demand for domain registrations remained robust. While alternative domain extensions like .xyz or .io have gained popularity, they represent a small fraction of the market compared to .com and .net, which are widely seen as the gold standard. However, of course, VeriSign is not without risks. Dependence on the ICANN contract means its business model could face disruption if regulatory conditions change. Additionally, the company operates in a relatively slow growth industry, meaning it must focus on efficiency and shareholder returns rather than aggressive expansion. Despite these risks, though, VeriSign's stability, profitability, and pricing power make it an attractive investment for a long-term value investor like Mr. Buffett. Buffett's move into VeriSign highlights his preference for businesses with predictable earnings and strong competitive advantages, which this company exactly has. The company's unique position as the backbone of the internet ensures its relevance for decades to come, making it an asset that Buffett can hold indefinitely. Of course, Buffett's probably not going to be around for a few more decades, unfortunately, but he is setting Berkshire Hathaway up for many, many decades of growth and stability and outperformance. Anyways, folks, that's a wrap for today. Which of Buffett's plays are your favorite and why? Let us know down below. Do you think that Buffett's style will continue to outperform, or do you think he's too much of an old timer? Let us know down below. And by the way, if you're ever coming to Costa Rica, make sure that you are prepared for these suckers here. The biggest grasshoppers I've ever seen. Some of them are like 7 to 8 inches long. Oof. Anyways, folks, that caps off today's video. Have a great rest of your day, and we'll see you next time.